Hi, hello, namaste. Namaste, everyone. Hello, Sharad. Okay, so can you quickly confirm? Can all of you see my screen, myself on the screen, and are you able to hear my voice clearly? Can we guys quickly confirm that by using the chat option? So, how was the week? Hey, Shubham. Good afternoon. Hi, hello, Jai Prakash. Very good afternoon. Debrata, Anshuman. Thank you so much, guys, for confirming. So, yeah, very good afternoon. Just quick confirmation. Okay, so is audio and visuals everything is clear? Hi, hello, Dabu, Ravi, Raj Singh, Lakendra Singh. Good afternoon, Amok. Hi. Hello, Satish. Okay, cool. So hi, Amol. Hi, Churamani. So hello. Well, very good afternoon, Krishna Pada. Okay, so thank you so much for confirming that. Just give me a moment. I'm sharing the screen. So can you guys quickly confirm that as well? So are you able to see the PPT or the screen on the, is the screen clearly visible? Hey, Shriraj, Rajan, Parmar, very good afternoon. Okay, cool. Thank you, Shriraj, and Shubham. Thank you for confirming. Okay, all right. So let's get into the subject. First of all, thank you so much for you guys. So basically for sparing your wonderful time, that on weekend. So definitely you deserve a lot of thanks. So thank you so much for your wonderful time, and especially like after this COVID situation, right? So basically after COVID situation. Uh, there is the future and options is like a buzzing word, so most of the people want to get into this, and they are very much interested to get into this, but not just future and options, but any particular subject, right? Any particular subject without understanding the fundamentals and the absolute basic and essential part of those subjects, if you are getting into that, that's the gravest mistake we can ever do, right? So in that perspective, we are here, and we organize this particular session. In today's session, we are going to discuss about future and options from the beginning, right? So by the way, I have a question. How many of you are absolutely beginner into future and options? How many of you are here? Hey, Divya Prakash. How many of you are absolutely beginner to the future and option session or future and option concept? Sorry. Super. Tejas is there. I want to understand. Deep is there. Gulshan Singh is there. Okay, cool. How many of you are already trading, or like you are already got the taste of future and option? How many of you are already trading in future and options? How many of you there? Okay, cool. So definitely this session is going to be very much exciting for me, and as I said, you guys are sparing your wonderful time on weekend, so it makes a lot more, it makes me a lot more responsible person, and definitely I'll make sure to put all my efforts to convey the best possible contents today. So today's discussion is going to be on futures and options, most exciting and vibrant discussion, by the way. And this session I'm going to divide it by two parts. The first part is about the contents that I have planned to discuss today. So I will be discussing all the contents that I have planned to discuss today, and after that, in the second part of the session, I will be taking all the questions. So in the first part, if you got any questions or doubts, or if you have any particular doubts on the session of today, so you can take a note of them, and you can ask those questions in the later section, so which is Q&A session. So well, let's get into the subject. So first of all, let's understand the basic part, right? So basic part in the sense, why the history of future and option, how it all started. The fundamental or the main root cause of this entire subject started from fear of uncertainty. Let me give an example. So let's assume that here is a gold. Okay, so try to understand, this is a very important example with which the entire session foundation is going to be, right? So we have a gold here, you can fit any particular service or any particular product onto this. So in this, just give me a moment. So here assume that there is a holder of the gold, or you can call him as a goldsmith, or you can call him as a jewelry shop, anything that already he is holding a physical gold with him, right? So physical gold with him, so we will call him as person A, right? So the person A is the holder of the gold, that means he already has a physical gold, but at some point of time, right, so he want to liquidate this assets, liquidate this particular gold after, let's say, 3 months. Okay, so this is a example. After 3 months he want to liquidate it. The main fear, right, the main fear of this person is that what if the gold price is subject to supply and demand and everything, right? So the market price of the gold varies from time to time. In that perspective, let's say after 3 months he has the fear that what if the gold price drops, right? So that is where he has the threat. So he don't have any problem with the rising price of the gold, because he already has the gold and he can sell it at a higher price. But the concern that is with him presently is that what if the gold price drops? This is a fear of uncertainty. So it is not the fact, but still he has a doubt or he has an uncertainty mindset now. So he want a solution now. At the same time, we have a person B, right? So we have a person B who want to buy the same product, who want to get into the same product, or who want to the same product, but here also he want to buy the gold after 3 months. So 3 months is the same, right? So 3 months period of time is same. What is the threat with this person? So he is thinking that what if the gold value increases, right? Because today assume that gold is trading at 2000 rupees, okay, per gram, per whatever the quantity, it doesn't matter, but 2000 rupees is where the present price of the gold is. But person A is thinking, what if the price of the value drops, so the price of the gold drops? So that means he will be in a loss, person A will be in a loss. And person B is thinking, what if the price rises? So presently it is 2000, but what if it crosses 2500, 3000? So he will be in a loss. So today he don't want to do that, so he want to exercise, or he want to execute this particular deal after 3 months. So this is a background. All right, so now this both people meet and they come to an agreement, they discuss, or they discuss and everything. After that they make an agreement saying that, let's say I will sell the gold, whatever the gold that I am holding, I will sell it after 3 months to you, so at 2000 rupees. At the same time, after 3 months, B also has to buy it at 2000 rupees, irrespective of the price differences or price fluctuations of the gold after 3 months. I will repeat it. So let's say today market is trading at 2000 rupees, the gold is trading at 2000 rupees. Both people are worried about the uncertainties of the price fluctuations of the gold. At the same time, so they are making an agreement, they are coming both and they are making an agreement saying that after 3 months, whatever the price doesn't matter, today we are seizing the price at 2000 rupees, so that even after 2 or 3 months, whatever the period of time, at that particular point of time, we have to exercise this particular contract, saying that the person A has to sell this at 2000 rupees, buy this at 2000 rupees. Let's assume there are 3 scenarios. Okay, so there are 3 scenarios. Scenario number 1, assume that price of the gold increased to 2500, right? 2500 in first case. Let me write here 2500 rupees. So obviously person A, there is no option for him, since he has into agreement, so he has to sell it for 2000 only. But who got the benefit here? Person B got the benefit, because at this particular price, even though market price is at 2500, he is getting the gold at 2000 rupees as per the agreement. And second, let's assume second scenario where gold price drops, right, by 500 rupees. At that particular point, let's say it is 1500. In this case, after 3 months, who will be in a loss? Definitely the person B will be in a loss, because he has to buy the gold from the seller at 2000 rupees as per the agreement, even though the gold price is trading at 1500. So definitely person A will be in a benefit. So more than the profit and loss, the main purpose, the main agenda of the derivatives market, don't worry about the derivative word, I will definitely come to that part, so don't worry about it. So basically the introduction of future and options introduced to the market because of the fear of uncertainty. This is point one. Point two, basically they are seizing the price of the future. So that is why we call it as a futures, right? So future price is predetermined and it's completely seized in the beginning of the contract. When the time of the contract comes, so they have to exercise the contract as per the agreement, irrespective of the market movement. So this is the main concept or the history of future and option. Now let's move on and understand what is derivative. So before understanding future and options is a part of derivative. So we need to understand what is derivative here. Let's understand that with another example. Say here I have noted coffee bean and a coffee, right? So coffee bean is an asset, right? So derivative means, in simple words, it's a financial instrument. Like we have an equity, commodity, currency, all those are financial instrument. At the same time, like equity is a, we can call it as a asset class as well. But mainly financial instruments, there are so many ways you can anticipate in the financial asset classes or a different type of financial instruments. In that, derivatives is one part, and derivatives is a financial instrument which derives its value from the asset class, from its underlying asset. So let me tell you an example here. Assume that this is an asset, right? So coffee bean is an asset. Okay, sorry, just a moment. Just give me a moment. Sorry. Let's understand this by this example, right? So what is derivative? So derivative is basically an instrument which derives the value from its underlying asset, which means at the other part of it, by default it will not have any value. It derives its value from the underlying asset. So what does it mean? So here we have a coffee bean, right? So coffee bean is an asset, right? Here in this example, and the coffee, which is a byproduct of the coffee bean, is a derivative. Okay, this is an example sake. I will link this to the stock market example, so don't worry about it. So basically, if the coffee bean price varies, right? So if there is any fluctuations in the coffee bean, that will be reflected, that will be impacted to the price of coffee, right? You can link this to like crude oil, petroleum products, all those stuff. So basically there is an asset, raw product or asset, and with respect to the fluctuations, price fluctuations of the asset of the final derivatives also changes. So let's example analyze this. Just a moment, sorry. So what is derivative? Derivative is basically a financial instrument which derives its value from a asset class, from underlying asset, and it is a contract that derives its value from underlying asset. And common underlying assets are like stocks, bonds, commodities, currencies, for everything. Like even for a pen, like here I have a pen. This, assume that this is an asset, and I can also create a separate agreement or separate contract for this particular pen, which becomes a future or the derivative of this particular pen. So this is an asset, that is a derivative. So let's move on to the next example. There are different types of contracts, but before that, let me give you an example of our own market, right? So how does it look when it comes to the stock market? Assume that we have a Reliance stock, okay? We have a Reliance stock here. Just a moment. So we have a Reliance stock here trading at 1,000 rupees, right? So 1,000 rupees, it is presently trading. Stock or the share is the asset, underlying asset. But we have a contract for this, or we have a derivative of it in the form of futures and options, which derives the value from Reliance stocks, which is the underlying asset. If the Reliance moves to like 1,100, so in that particular case, the derivative of that product, so like future also will move to 1,100. It will not be exactly same, but there will be certain slight differences, but which is okay. So basically in this particular case, until the expiry, there will be a different slight differences, but on expiry date, definitely this both has to compare, and this both has to be the same, right? So basically in this particular sense, derivative is a financial instrument which derives its value from an underlying asset. For Reliance example, we have a Reliance futures and Reliance options separately. So we'll come to that part now. So let's say, so just give me a moment. Okay, so guys, I have a request for you. Kindly hold your questions, or you can ask the questions in the Q&A session. So you can take the note of it. Yeah. So now let's move on to the next point, which is types of derivatives. So as I said, So initial markets, the example that I was giving in the first place, so which was basically forwards contract, right? So forward contract that was used to happen in the OTC model. So over the contract, so physical settlement was there. Physically, one has to go there. The contract between the contractors, the one who is getting into the contract, so they has to go physically and they have to interact with them physically. So that was the issue. So there was a lack of regulation, lack of system, lack of proper interface and everything. And then we have a swaps here, which is basically like for big guys. So for banks and also they big institutions, the concept is same, but they do it in the swap. So let's concentrate on this. Due to the lack and due to the system requirement in the point of transactions of forwards, we got future and options, which we can call it as just a moment, which we can call it as exchange traded derivatives, which is the subject of today's session. So futures and options. So here you can see this is a statement. So let's understand with certain examples. So then we will get complete clarity. Let's dive deep into the concept of future, how future contract works. So listen to me carefully. This is a very important key information. So here, before we understand how future contract works, we need to understand how the regular transaction of stock market works. So basically, like so far, if you are completely new to the futures or options market, so basically you already have an idea about how stock entering into the stock works. So stock or the share, we can call it as an asset. That means it has a value with the share certificate. So now we are dealing with an online mode. So basically it has a value. So that sense, we can call it as an asset. So how you own an asset? Basically by buying it. So your first action is to buy, and then the next action is to sell. When you are buying a stock on for the long term, that means you are owning the ownership of that particular stock. Okay, so when you want to come out of that ownership, so you have to sell it. So that is the basic cycle that we are comfortable with, right? So but with future and options, it get little complex. So I will simplify it for you, don't worry. So regular transaction is buy and sell. So there is only one way you can make money, which is by buying low, right? Buying low and selling high. In this scenario, you can only make money with this example, right? So now let's get into the futures contract. How it works is basically there are two modes with which you can enter into the contract. So I want to repeat it, right? So when you are entering into the ownership of particular company, that you are owning a company, but here you are getting into the contract. Futures or options, both are the agreement or the contract. Whenever you are entering into the contract, there are two modes, right? So first one, we can call it as a long, right? So long, what I mean to say is basically like regular transaction that we explained in the first step. So basically, let's say you are thinking the Nifty will stay above 16,000 or market will move above 16,000 at the expiry. Okay, so don't worry about the expiry. I will also come to that part. So assume that you are expecting market to move up. So this is your wave. So you are initiating a long position. So that means you are buying in the first place and then you are selling it. So basically, when you are entering into the contract as a buyer of the contract, that means you are entering into the long position until you hold the position without closing it. So how to close the buy position? Obviously by selling it, right? So until you close that particular position, you are in the long position. That means your long positions are still open in the market. This is point number one. Point number two, getting as a short seller. This gets little tricky here, so kindly concentrate. Let's say you are trying to short the market. So I think hope you have heard this particular term. Short selling is basically you are entering into the contract as the seller in the first place. You are a seller of the contract in the first place. In that sense, your first action will be selling the contract. So at that particular point of time, if the market moves below, right, below of your exercise the price, in that particular sense, you will make the profit. If market moves above the expected price, then you will make the losses. So exactly ulta to the long position. So this is how we execute the short sell. So if you are short selling the position, that means you are selling the contract in the first place. And if you want to get out of that particular contract or come out of that contract, that means you have to buy it. So we don't call it as buy or sell here. We call it as squaring of the position. When you are into futures market, so basically when you are initiating a long position, you are a contract buyer in the first place, and you are a contract seller in the first place when you are shorting the market. So when you are short in the market, if the market moves below, you will make a profit. So this is the beauty of future and options market. So ideally, equity market or any particular asset class, the only way to make the money there is to own the asset and sell the asset at the higher prices. So that is the only way. Buy and sell, one side transaction is only where you can make money. But here, future and options, you can also anticipate and participate in the downside rally of the moment. If market moves down, you will make money when you are short. Assume that let's take a number example, right? Let's say you are shorting Nifty at 16,000 rupees, right? That means you are entering into the contract as the seller in the first place. And if the market drops by, let's say, 200 points, which is 15,800, so you will be in a profit even though market goes down. So because you already sold the contract at 16,000, at 15,800 you are coming out of the contract. That means you are making 200 rupees profits, wherein the regular long position is very simple to understand. Basically, you entered at 16,000, so this is where you entered the price, and after that market went up as per your expectation. After that, whatever the price comes there, so that will be the profit for you. The only losing scenario is basically it's a normal regular transaction. So if the market goes below 16,000, you will make losses, wherein in this case, if market goes above, you will make the losses. You can anticipate both up and down movement of the markets using the futures contract. So let's take an example of some particular example. Let's say Reliance, right? I think I'll explain it by the use case. That will be more helpful for you. So just give me a moment. Just give me a moment. Let's discuss the use case, right? So what is the use case, or where we can use this particular information, or where we can trade the futures contract? What is the use case? Number one, the main use case of futures contract is to hedge the asset. So let me give an example. You will understand it clearly, right? So here, assume that you own a Reliance share, any particular share. That okay, whatever the share you like, Reliance share. Assume that you are holding 1,000 shares of a Reliance, right? So this is an asset that you are holding. You believe in the business and you want to be with them for a long run, and you have a complete conviction. But because of some reason or because of some information, you have an uncertainty mindset now. So which means, what is the threat that you have? Obviously, when you are owning a share, what if the price drops? So because of some reason, right? So in that particular case, you will have three options. Number one, accept the loss, right? So let's say market can go up to 500 or 400, or even we don't know, right? So you are completely ready for the loss. This is number one. But what if you are not ready for it? Then comes the second option, which is exiting from the entry. So exiting or liquidating my present holdings, which is also not comfortable in some case, because you also believe in the business. Just because you think, or just because of some outside information, now you started to think that this business is not working. So you don't want to take a chance. You want to be in that particular business for a long run. That is also a not desirable choice. Number three comes in, which is hedging. Hedging means, let's say 1,000 rupees at the present moment, 1,000 stocks you own, and the same stocks. So let's say, assume there is a Reliance future, right? Reliance future, which derives its value from the Reliance stock. So assume that presently market price is at 2,000 rupees. Okay, 2,000 rupees presently trading. You are concerned about the market fall. So in that particular case, you can short sell the Reliance future, right? Approximately the present, as per the market price, it will be at 2,000 rupees approximately. You are shorting, or you are short selling in the first place, so that after this, like there is some uncertainty event or something like that, because of you're worried about, so that event comes in and all the volatility subsides, and after that there is a scenario, right? So if the market drops as per your expectation, if the holding value drops, so you will make a money in the Reliance future, so that you can offset with the asset that you are holding. This was the ultimate, I mean, this was the main foundational use case of futures contract. And the second use case is to speculate it. That means you are trading into this. So let's say you are anticipating, or you are expecting Reliance share to go up, so you can either buy the direct shares, which is possible. But what if you want to anticipate a short selling? So that means if you are expecting market to go down, but there is no option for you to anticipate that particular information in the direct asset. So you can do the same thing using the futures by short selling it. That means entering into the contract as the seller in the first place. If the market works in your favor, if the market drops, then you will make the profit. If not, then you will make the losses until unless you close the position. So I hope you're getting the point. Number one use case is to hedge. That means you are protecting yourself from any particular uncertainty. Number two is the use case of speculation, which is nothing but the trading. All right. So now there are different types of stocks. There are different types of futures again in that. Just a moment. Just give me a moment, guys. Sorry. Yeah. So stock future, basically the same contract. The concept behind every futures remains the same. So stock future means you are dealing with the stocks. It's as simple as this: Reliance, TCS, all those stuffs. And there are future and option stocks. Particularly, there are 2,000 plus stocks listed in the stock market. All the stocks are not in futures and options market based on some regulations, based on some framework. So there are around 200 or somewhere around 150 190 plus stocks which are listed as a future and options. That means there is a derivative of those instruments based on liquidity, all those stuff. So basically stock future means the future contract that derives its value from the stocks, so any particular respective stocks. Number two, index future. So this is where the things gets more exciting. Most of the people are now trading in index futures. What I mean to say is the major indices like Nifty 50, Bank Nifty, so all those we know, right? So basically they are the index of certain group of stocks, so that we cannot directly trade. Even if you want to trade it in the equity market, it is not possible. But the wonderful opportunity with this particular thing is that you can trade the index in the derivatives market, futures market. So let's say Nifty 50, right? Nifty 50, you want to trade it. So since it is an asset, since it is a reference point, for that there is a derivative which is called as Nifty 50 future, FUT, right? FUT. So this you can trade and you can work on your particular way. So that is index future. Mainly the most liquid index futures presently in our market is Nifty 50, which is number one, and number two, Bank Nifty. And recently there are many index futures are getting introduced to the market, and most of the people are fascinated, and they are they want to trade in the index futures because of the liquidity which is available. That means more people are here. And then comes the currency futures like pairs, USD, USD INR, Euro INR, all those stuffs. You can also trade that. If it is related to currency, then we can call it as a currency future. And also there is an options into that subsequent part. So I will discuss options separately. So commodity like crude oil, gold, silver, all those stuffs are commodity futures. Interest rate futures, this is not that much famous in our our market. So basically interest rate in US and countries like US and UK, so they have a interest rate future. So for the interest rates they have a future. So it's as simple as that, right? So if I have a authority, so I'm holding this pen, I consider it as an asset, and for this I can create a separate contract or the separate futures for this. So that derives the value from this particular pen. So similar to this, in that particular sense, that's its pen derivative. All right. So now let's move on to the next point and discuss about the advantage and disadvantage. This is so important because see, for every particular instrument, especially financial instrument, there is an advantage, there is a disadvantage, there is a risk involved. Especially derivatives market contains more risk than any particular financial instrument. I will tell you the reason why. Number one, let's understand the advantage part. Good things first, let's understand it. They provide high leverage in order to gain maximum amount with limited investments. Okay. So what it means to say is, as I said, the fundamental use case of futures market or any particular derivative market is to hedge from the uncertainty. For that, they should not be, right now you are holding 10 lakh rupees worth of share. For that, you want to hedge. So again, you don't need to bring another 10 lakh rupees for it. So in exchange provide you the facility to get the same contract, get into the same contract, like using 20-25% of the amount itself. For example, 10 lakh, so 2 lakh rupees, 2.5 lakh rupees, you can get into the same value of the contract without worrying anything. So this is the main use case, and which is called a margin, right? So whatever the amount that is required to get into the contract is called a margin. And you don't have to pay the upfront margin, complete upfront margin for it. So as per the exchange, around 20%, 25% of the overall contract value. So contract value in the sense, basically you cannot trade, you cannot participate in the futures or options market with one single share. So there will be a number of shares grouped into one particular pack, which is called a lot. So I'll try to note down here, which is called lot, and there is a lot size. So basically lot in the sense the group of number of shares. So for example, Nifty 50 is that means 50 number is the minimum numbers you can anticipate the trades. You can either go for short or long, doesn't matter, but 50 numbers you have to transact. That is a minimum contract size, right? So that is how the overall futures market works. So for that, you don't have to bring the complete margin. So based on the margin requirement of individual stocks or individual index, based on the instruction of the exchange and the SEBI, so you have to arrange the upfront margin for that. And then comes the major next point is allow hedging against future risk, that I already explained to you. And basically it gives you an opportunity to protect your asset from the uncertainty. So that is the major advantage. Then comes the disadvantage, again leverage. So that means you are getting the leverage product. So instead of 10 lakh, you are giving 2 lakh and you are getting into the contract, which is one side. Yes, of course, it offers the greater rewards, but at the same time, it comes with a greater risk. What I mean to say is that, let's say 10 lakh rupees worth of shares, you are buying it by paying 2 lakh rupees, right? So what is your actual amount? 2 lakh rupees. But what is the actual worth of the contract? 10 lakh rupees. If market moves by 1 point, right? So 1 point, you will make a loss of, let's say you will make a profit and loss of 5,000 rupees. 5,000 rupees considering to 10 lakh is lesser than comparing to 2 lakh, the approximately 2 to 3% of up and down movement. This is where most of the people are getting excited towards this market, because it requires a less money comparing to its contract value. That is an advantage. If you know how to deal with it, that will come as an advantage. But at the same time, it is also a major disadvantage, and most of the people lose money here without understanding the proper calculated risk here. So that's why it's always better to calculate your risk before you get into the contract or get out of the contract. Understanding and managing the risk is the ultimate goal in the first place when you are dealing with the future and options. All right, so now just a moment, give me the moment. Just a moment. Yes, you will get a recorded session. Don't worry, you can watch this video after the session, completion of the session, right? So now let's move on to the next subject, which is options, the most exciting and the most vibrant subject, I can say. So it is little complex to understand, but I will simplify it for you with an example, right? So let me tell you the story. Okay, tell story of yourself only. So you are the person A. Okay, assume that you are the person A. Just a moment. Just a moment. Assume that you are the person A, right? So you have a good friend and very budding friend, good friend. Okay, so he owns a land somewhere in the desired area of yours, and you desperately want that land from your friend called B, right? Now you have you desperately want this land, but you have a threat here. That means someone told you that he's selling a land, but someone told you that with near to this land there is bad news or bad construction is going to happen. So because of that, there is a threat, the land value can decrease. So this is the information that you got. Now you want the land at the same time, but there is a threat. So now you are a smart person. So what you do is basically you get into the contract with your friend saying that, understand it carefully, right? Let's say the worth of the land is 10 lakh rupees. 10 lakh rupees. I will pay you an upfront fees of, let's say, 50,000 rupees. Okay. So let's say I will pay you 50,000 rupees now, but after 6 months, because as per the news, within 6 months, there is a bad construction or something bad related to land is going to happen. That is what the news you received. So after 6 months, after 6 months, you want to buy this land from him, and you are telling your friend that after 6 months, I will have a right to say no. I will have a right to say no. So I will repeat it. So he want to sell this land at 10 lakh rupees. Now you don't want to buy it. After 6 months, you want to buy it by paying the 50k rupees as the advance amount. And you are saying him that I want this land after 6 months, but I will have the right to say no for it. You should not be forcing me for anything. So you should be completely okay with it. For that, this is a very important point. For that, I'm paying you 50k amount, 50k as an advance. It is a non-refundable advance. So this is where the things gets a little more exciting. So basically, he's paying 50k amount as a non-refundable. So suppose, let's say after 6 months, that news that he received, the bad news about the land near to the land, which came true, and the land value drops. So he, as a buyer of this particular land, so he is buying now after the transaction which is possible to happen on after 6 months. So he has the complete rights to say no, I don't want this land. You can keep this land, but at the same time you will lose your 50,000 which you have given as an advance amount to get him into the contract, this particular contract, right? So if suppose, let's say, price increases, the land price increases at that particular price of time, then he has to sell you for the 10 lakh rupees only. So he don't have any options to say no. The complete rights will be there with you as a buyer of the land. So this is exactly how the options market works. Let me give you an example. I hope you are getting the point, right? So the initial amount that we have paid as an advance there was the premium, the token advance that you paid, the non-refundable amount, which was the premium. Let's understand this with respect to the market, how this works. So assume that market is presently trading at 16,000. Okay, so the Nifty is trading at 16,000 rupees. There are three possibilities. Either it can stay there, or it can move up, or it can move down. So this is the only possibility. Assume that you want to buy the Nifty, but at the same time you don't want to take the risk, because futures, if you buy the futures, obviously in that particular perspective you are carrying the unlimited risk. If the market started to move down, you will carry the unlimited risk there. And second point, you cannot even direct participate here, or you cannot participate in the equities market because it is an index. And second important thing, even though you are buying it, you don't have a sufficient margin, so you want to take the leverage of the margin. So in this particular case, you can initiate the long position in the future, which is also not desirable. But there is another option, which is getting into the options agreement, saying that, let's say you found a seller, okay, found seller of the contract of the option, who says your view is to market will stay above 16,000. But the opposite person who came and say, okay, so he has a view, different view and different complete view altogether. He believed that market will stay below 16,000. That is why he asks you 100 rupees. Okay, so give me 100 rupees. So I will enter into the contract after certain time. Okay, so which we can call it as an expiry as well. At the time of expiry of the contract, if the market moves up, right? So as per your view, if it moves, I will pay you whatever the amount that comes in, right? At the present moment, it is 16,000. He is asking 100 rupees premium to get into the contract. And after that, whatever the amount that comes in, right? Whatever the amount that market moves, I will definitely happy to pay you. But at the same time, if market stays below 16,000, I will not pay you any amount in this, any amount in the 100 rupees premium. I will keep this in my pocket. So he is the one who is getting into the contract like this, is called an option seller. Option seller, who is offering a premium for getting into the contract, and at the same time he is also committing, or also he is saying that whatever the upfront intrinsic value that is there, I will pay you that at the time of expiry. So in this case, assume that you are entering into this in the option segment, and you are buying a premium. You are buying a premium which is called the call option, right? Call option. Call option, you are buying a call option. That means, let's say 16,000 call option. Here one more term comes into the picture, which I will explain you later, but now I will give the hint. In the options, you also have the possibility, or you also have the option to select the particular price level. So assume it again depends on your conviction, depends on your view. So at the moment you are believing that market will move above 16,000. That is why you are entering into the contract of 16,000 call option. 16,000 call option as a buyer. So in that particular sense, let's say you are paying 100 rupees as the premium. right? Buying as 100 rupees as a premium. So at any given point of time, what is your break even, or where you will start making money? After market crossing 16,100. Until that, the entire deal will be in the favor of the seller of the option. So the beauty of option buying in this particular case is that the maximum loss you can lose is 100 rupees, because buying an option basically means you are paying the premium to get into the contract. So the maximum loss you can occur is 100 rupees, and the maximum profit which is there in the maximum potential is unlimited. So its risk is limited, which is 100 rupees that you are paying as a premium, and the unlimited risk reward potentiality, which has to be paid by the option seller, who is more confident in this particular case, who is more confident that market will stay below 16,000 at the time of expiry. So let's take this particular example. So this is what we can call it as a call option, right? Call option. So next, understand the same example with a different view. Assume that you don't want to take more risk here, right? So just a moment. Assume that you don't want to take a more risk, and you are, just give me a moment. Yeah, let's say market is presently at 16,000, right? 16,000, but you are expecting, listen to me carefully, you are expecting market to go down or fall below 16,000 at the expiry. That means your view is bearish. So in this particular case, what is the options you have? Either you can short sell the market in the futures market, which again comes with unlimited risk and unlimited reward potentiality. You don't want unlimited risk, you want to participate it as a safest player. In that particular case, what you can do is you can also find a seller of the put option. This is what we can call it as a put option. The same example, let's say the seller comes in and say, see, I believe that market will stay above 16,000, my view is bullish, so I am ready to pay you 100 rupees. I am ready to receive 100 rupees and getting into the contract, saying that if the market drops as per your view below like 15,900 rupees, whatever the amount that falls in, so I will pay that amount at the time of expiry. So this is the deal. Whatever the amount is, unlimited amount, I can pay that. But at the same time, if the market stays below above 16,000 in this case, so market rises above 16,000, I will not pay you anything. So I will keep the entire 100 rupees premium in my pocket. That is what the seller says. But wherein the buyer says, let's say in this particular case, the maximum risk that a buyer has is the 100 rupees premium that he paid. So he will start to make money when the market falls below 15,900. Whatever the amount or whatever the price that drops here, that amount he will make, and that amount has to be adjusted, or that amount will be given by the seller of the contract. So this is how the things work. So this is what we can call it as a put option. So let me write down put option. So call and put option, when you have in a simple sense, I also have an example for it, don't worry. So when you are expecting market to move up and when you are expecting market to rise, in that particular case, you can anticipate the buyer by buying the call option. When you don't have a much more confidence to anticipate the unlimited risk, you want to play safe, in that particular case, you can buy the call option. At the same time, you can also sell the put option, but it comes with the unlimited risk. So selling the options comes with the unlimited risk, buying the options comes with a limited risk and unlimited potential. So let's move on to the next slide and understand the next concept, which is American options and European options. The options that we are presently trading in our market is basically European options. The main difference is that American and European options is basically like right exercise. So the buyer has the rights, he can call off the expiry at any given point of time in the point of American options. So but European market, in the European options, we have a particular expiry date. On that expiry date only, we have to transact we have to settle the deal. So that is the main difference. That is why you will see, like whenever you see the call and put option in the broker's terminal, you will see it as CE and PE, right? E means European options. So the options that we are presently trading in our markets is basically European options. Similar to futures, stock futures or index futures, there are stock options, there are stock futures. Let's move on to the next concept. So type of options, I think you already got the idea what call option is all about, what put option is all about, and then move to the next point, which is must knows of options. This is so critical, please concentrate. and I will also demonstrate you how it looks like and what is the variations, what variations of the market will affect the options pricing. There is little complexity involved there. I'll try to simplify it for you, so don't worry. So here the first thing is the strike price. As I said, in the futures contract, right? In the futures contract, we are directly dealing with a futures contract, straightforward deal. So there is no complexity involved. Directly, whatever the price you are getting there, that price you will get as the buy or the sell price. But here in the options, we have a strike price separately. So that means you can choose the strike prices as per your view. Assume, let me give an example. Market trading at 16,000, example, right? So you are expecting market to stay above, or you are expecting market to move above 16,000, then you initiate the 16,000 call option. If you are a buyer, if you are a seller, you can also sell the put option. This is one point. So assume that in other case, let's say 16,500 level, you have a strong conviction or a confidence of that market will cross above 16,500 to the expiry. So in that particular sense, you can directly participate in 16,500. That option is also available. The only thing is that the more you increase, the possibility of price reaching that level also decreases. So in that particular sense, the premium that you pay for this, because market is presently at 16,000, the premium or the token that you pay here will be generally more comparing to the premium that you pay for 16,500, because you are taking more risk in this case comparing to this thing. So in that particular case, the premium will also be less, and the opposite side, the seller of the option taking less risk in this particular case, because there is still 500 points to go or move up. In that particular case, you are not paying anything than the time value here. So I said time value, I'll come to that part. So basically, you have the different strike prices to select. You can also go in like 15,500 call option. So when you want to be a buyer of the 16,000 call option, you will be called as an ATM buyer. So that's what we have written here. This is called an ATM. That means the nearby strike price to the present market price. Let's say market is trading at 16,030 somewhere around. So for that, 16,000 will be the at the money strike price. This is point number one. Assume that it is a call option. Assume that you want to be a call option buyer. In that particular case, the 16,500 strike price will become OTM. What I mean to say OTM is basically presently market is at 16,000, but the strike price is at 16,500, which is far away from the present market price. In that sense, it will not contain any intrinsic value. What I mean to say by intrinsic value is basically the difference between the present market price and the strike price. So in the call option, market has to move up. So after, when it will gain the 16,500, assume that the premium of the 16,500 is at 50 rupees. That means when it will gain the money value, when the market price from 16,000 it crosses to 16,500, 16,501, 502, 503, as in when it starts to increase after 16,500, then it will start to increase its intrinsic value. That means the overall amount that you are paying as a buyer of 16,500 call option in this case is basically the overall, it's a time value for the time and the chance, and the overall the chances you are paying that amount intentionally. So you don't have any particular value left in that particular option. So assume that you are paying 50 rupees premium for 16,500. In that sense, the entire 50 rupees premium is for the opportunity cost. It is not a time, it is not a money cost. So assume that you are buying 16,000 ATM call option, wherein the time of buying, at the time of buying or any particular time, so if it crosses like 30 points above 16,000 call option, in that particular case, the 30 rupees, the difference between the strike price and the present market movement, so that will become your overall money value. So 30 rupees is the money value. So that's what we call it as an intrinsic value as well. So then comes the option expiry. For every derivative, it may be a future or it may be an options, there will be an expiry. Basically there are three major expiries. Now for options, we have a weekly expiries as well. So every Thursday there will be an expiry. Most of the cases on Thursdays we will be having an expiries. Weekly expiries are there for Nifty and Bank Nifty both, and even currencies also recently got introduced to weekly expiry. But the futures contracts, right? Future contracts will expire this month, next month, and next month. So for Nifty, it is a major index. So that's why we have till 1 year also. You can also have different options and also different futures. But most of the time, the most liquid contracts will be available for this month. This month is the most liquid contract, and next month is the far and far away. So this month, next expiry, the far expiry. So 3 months after. So these three contracts will be these three contracts will contain basically more liquidity. Then comes the option premium. Remember our example, the amount that we pay in the initial time to execute or get into the contract, say the non-refundable amount, that we can call it as an option premium. And ITM, OTM, ATM, based on the options nature. Assume here I was explaining about the call option. Put option is basically, let's say 16,000. The put option will gain its money value at 16,000. Put option will gain its money value only when the market fall below 16,000. So then that amount, so in that particular sense, right? So we can call this as the ITM. So usually the strike price which is near to the present market price, we can call it as an ATM. So anything above that for a call option, we can call it as an OTM. For a put option, we can call it as ITM. So similarly for call option, so anything below the present market price, we can call them as the ITM for call option, and we can call the below prices of put option, we can call them as the OTM when it comes to the put option, right? So now let's move on to the next slide and see the next point. So here are the 4 ways of trading options. Be attentive here. This is also one of the important slide. So there are 4 ways with which you can anticipate the trades in options. So basically the first option is to buying the call option. That means when you usually buy the call option, you make money when the market moves above, especially if you are holding it till expiry after your premium. Let's say your premium is 100 rupees, you are paying 100 rupees premium. After that, whatever the price that stays as a money value, so that you will get it as a profit. At the similar time, anything that falls below, the maximum loss is held at 100 rupees, which is the premium that you paid. This is point number 1. And point number 2 is to selling or writing. We can also call it as the writing of an options. It may be call or put. So that's what you are entering into the contract as the seller in the first place. In that sense, you are writing an option, or you can also call it as short selling an options. Doesn't matter. The concept is very important. So when you are selling a call option, so usually your view is bearish. So when the market moves below the strike price, so right below the strike price, you will make money. What is the maximum profit you can gain when you are a seller? The premium that you received from the buyer. Let's say 100 rupees you received as a premium to get into the contract. In that particular case, 100 rupees is the maximum profit you can gain when you are a seller of call option. So if the market moves up, this is where you have the threat. So you are selling a call option. So sorry, here you have a bearish view, right? So if market moves down, you will make a money. If market moves up, you will make a loss. In fact, unlimited loss. Let's say you have collected 100 rupees. That means this is a 16,000 level, and anything above 16,000 level, after 100 rupees of the premium that you have received, you will start making losses, unlimited losses, right? So then comes the next example, which is, let me take an example. Just give me a moment. So buying a put option, right? So when you are a buyer of the put option, that means you are expecting market to move down, or you are expecting a crash. So let's say market is presently trading at 16,000 rupees. Whatever the, if as per your view, market starts to fall. So let's say you are giving a premium, 100 rupees premium. After your 100 rupees premium, that means in this case, 15,900, whatever the money value that it gains, you will make a profit, unlimited profit. When you are a buyer of put option, you will make a unlimited profit when market falls. And similarly, if market goes up, that means it is working against your view. In that particular case, you will lose the maximum amount of 100 rupees you have paid for the seller or the writer in the form of premium. That is the maximum loss you can attain in the opposite side, right? So just a moment. So here we have the next thing, which is writing or selling the put contract in the first place. So the same example, the market is presently trading at 16,000 rupees. In that particular sense, in this case, if the market moves up, that means you are safe. You are expecting market to stay above 16,000 level. In that particular case, you will make a profit of how much? Let's say you have collected 100 rupees premium, so in that case 100 rupees is the maximum profit you can gain. At the same time, if market started fall, in this particular case put option value will increase, because it starts to gain its intrinsic value after crossing the premium rupees. So 100 rupees is the premium, and if market started to fall below 15,900, you will start to feel, or you will start to have the unlimited risk when it falls below 15,900, right? So then we have a next slide, which is very important, but at the same time I don't want you to lost in this particular information. This is needed, but not that critical. In that I will explain you the basic part of it, right? So I don't want you to confuse here. So option price is not simple as future, so it has a lot of complexity. As I said, the many things affects the options pricing, right? So basically it's called as an option Greeks. Based on the behavior, individual Greeks has its own importance, has its own behavioral factor, and it affects differently to the options pricing. First of all, let's understand delta. In simple words, the price movement that happens in the underlying asset. So let's say Nifty 50 call or put option, so that will be affected, the price of the put or call option will be affected based on the price movement of the underlying asset, which we can call it as delta. The price changes. Next comes the gamma, right? So listen to me carefully. 100 points of the movement, 100 points of the Nifty movement in the span of 30 minutes, 100 points of movement of the Nifty in the span of 2 hour or 3 hour. Is there any difference? It has moved by 100 points, but the major difference is how much time it took. So that is what we can call it as gamma. The rate of change of price movement of the underlying asset is what we can call it as gamma. That will also impact options price. Will shoot immediately, it will increase its value immediately when there is a huge momentum. And at the same time, if the market is laggy, even though market is moving upwards, the pricing of the options will not increase with the intensity. So that is what the gamma is. And vega is a volatility factor. So let's say there is an expected news, so expected news nearby budget or anything particular news, obviously the higher volatility can be expected, up or down doesn't matter, but volatility is expected on that particular date. In that particular sense, it is an expected news and expected volatility. In that case also options premium will increase. So you can know, you can go and check back, or you can see the information in the NSE website and all. So after this session, so at the time of corona, even call and put option, both premiums were increased, because the reason is, let's say you are a seller of an option. So when there is an expected news, expected volatility, so obviously you don't want to take a chance, because you are exposed to the unlimited risk. So in that particular sense, you will obviously demand for the higher premium. And when you are a buyer, you are also in the same situation. So obviously, even though there is a higher premium, you are okay to pay that higher premium. So that is why ultimately the premiums will increase based on the expected volatility and the implied volatility. So the present volatility of the market, suddenly let's say in the afternoon some news came in, whatever influence, because of some news influence, suddenly there is a movement, and that volatility will also impact the options pricing. So then comes the theta. Theta is a wonderful part, or wonderful segment of the entire options pricing. It's basically the time value. As I said, options premium mainly have intrinsic value, which is nothing but the difference between your the strike price and the market price. That is, we can call it as an intrinsic value. Whatever the amount that is left after the intrinsic value, in simple words, we can call it as a time value. So near the expiry, obviously lesser the premium. So longer the expiry, chances of the price reaching those strike prices are quite high. That is why option sellers are asking for a higher premium. The longer the expiry, higher the premium. Lesser the shorter the expiry, then the premiums will be lesser. So then comes the RHO. It is like interest rates. So interest rates of the particular country also impacts the options, but not necessarily. So basically, if you are good at understanding the underlying asset, then obviously the price changes of asset will be taken care in the delta, and the momentum with which it moves will be taken care by the gamma. Vega is basically the volatility part. If there is a higher volatility, expected or present volatility will be reflected in the price of the premium. And the theta is basically the anything which is left after everything is basically the theta, which is you giving for taking an opportunity of the time, right? So let's move on to the next point. and understand how to trade future and options. Don't worry, after this particular slide, I'm going to take a question. So let's do this. Just give me a moment. Just give me a moment. So I have taken a screenshot here. The Groww app. This is the Groww app home. This is how it looks like. And if you can see here, just a moment. Just give me a moment. Just give me a moment, guys. Just a moment. So as you can see here, the moment you open the Groww app, but before this, kindly make sure that you activate the future and options to trade in future and options, right? So here we have a future and options section. Can you see that, right? So here also you can access, or here we can see the search option, right? So there also you can access it. So let's move on to the next step. Let me erase this. So as you can see that I'm clicking on the future and options. The moment we got into the tab of future and option, you can see we have simplified the way of way how it looks. So just a moment. So as you can see here, oh wait a moment. Sorry. Wait. Just a moment. Yeah. So here, follow my cursor. So here we have a Nifty and Bank Nifty, which is this is where you can access the options chain. Options chain in the sense, very simple. Left side, there will be a call option, there will be a put option. I will show that. So different strike prices, different options premiums, different price behaviors. So that we will see it in the next slide. So it will come. So basically the Nifty and Bank Nifty options chain, you can access from clicking on Nifty and Bank Nifty, both, right? And here we have, what is happening, man? So this is where we get into the future and options, and the most active for that particular day, the most active stocks future, index future, stocks options, index options will be available to see here. In this particular case, you can see top traded futures for last trading day was Idea future and PNB future. And index future, of course, Nifty and Bank Nifty, nobody can beat that at the present moment. So they are the most liquid indexes in terms of the index futures. And then see, this is what I mean to say. You can access this particular thing. So this is what we can call it as an option chain. Follow my cursor. Left side, you can see call price, right? So these are the call options of these different strike prices. You can see presently market is at 17,670. That means the nearby at the money is 17,650. That is a strike price. 17,650 call option is presently trading at 147 rupees, and 127 rupees is the put option. So this is what we can say it as option chain. For individual instrument, we will have an option chain separately. And next point is, I want to get into this, just a moment. You can buy or sell. Can you see I'm clicking on the call option, the present price, which is at 47, so 147. If I click on that, I will receive a window to buy and sell it from the option chain itself. You can buy and sell this particular contract by using the same price which is shown on the display, right? So you can also do the same thing for put option. So this is how you trade the normal call and put option. And give me the moment. So for even Bank Nifty also, I'm just showing the same example. For Bank Nifty, there is a separate option chain. As I said, for different instruments, you will find different option chains separately. And the index future, like as you buy and sell shares on the Groww app, similar to that, you can also buy and sell the futures contract by using the same method, right? So just make sure when you are short selling, you are entering into the contract as a seller. When you are initiating a long position, that means you are entering into the contract as a buy seller and you are squaring it off as a sell. When you are in a long position, when you are in a short position, you are exiting that particular contract as a buyer, basically, when you are short selling in the first place. So that's it from my end. Thank you so much, guys, for your wonderful patience, and thank you so much for your wonderful time. Now let's get into the questions. So if you have any particular questions, please ask them in the comments. I'll be more happy to answer the questions now. Thank you, Sharad. Thank you so much. Any particular questions regarding today's discussion, I'll be happy to answer. For option bearer, which expiry is better to take? Okay, so there is a question from Chinmay which says that for option buyer, okay, for an option buyer, which expiry is better to take, weekly expiry or monthly expiry? It depends on your view, it depends on the risk taking ability. So it's as simple as that. If you are a buyer, so if you want to buy the weekly option, you have the less time. That means you are paying the less premium, but at the same time you are also taking the more risk because the time of expiry is very near. Your desired expected price or desired expected movement may not happen in that short period of time. That is why you are paying a less premium. In that particular case, right now, in terms of the liquidity, we have more liquidity in the weekly options. In that sense, definitely one can go with the weekly options. In that also, you can trade the ITMs in the money if you want to be a buyer. Slightly ATMs, slightly ITM or mainly ITM. With that, you can, just a moment, you can avoid the unnecessary like a time decay or time reduction of the price. Thank you, Vidyadhar. Thank you so much. Any strategy you want to give for intraday? Well, stay tuned. We have another channel called Trading with Groww YouTube channel. So we are dedicating completely that particular channel to give you the idea about trading. So maybe like future and option trading and normal trading, technical analysis, everything comes in that particular channel. Make sure that you stay tuned and make sure to subscribe that channel as well to get the regular updates about trading. We will be we'll be uploading many strategies over there. Thank you. Okay, there is a question from Aman Singh. No OTM option buying. So why cannot I buy OTM options buying? See, I'm not saying not buy the OTM options, but understand the risk behind it. When you are buying an option which are OTM, out of the money options, obviously you are taking more risk because chances of price reaching or price crossing that particular strike will be less comparing to the present ATM. So that is why you are taking more risk. At the same time, if market didn't reach that particular level at the level of expiry, at the time of expiry, you are going to lose the premium. All right. Strategy, yes, strategy part will be uploaded in our Trading with Groww YouTube channel. You can subscribe to that channel to get the regular updates on trading. Any strategy you want to share? So it's basically technical analysis. You can study the underlying assets and just a moment. You can study the underlying assets and based on that, you can take the actions. The beauty of options is that you have a lot of options. You can build different strategies over there. So definitely we'll try to make a separate videos for that in the Trading with Groww YouTube channel, right? Okay, what is meant by straddle? Straddle means, in simple words, you are buying or selling. Doesn't matter if you're buying the straddle, that means you are a buyer of the straddle. If you're selling it, you are a seller of the straddle. So let's say market is presently trading at 16,000 rupees. So 16,000 ATM, 16,000 ATM call and 16,000 ATM put. You are buying same, you're buying both at the same time. You also have that option. So in that particular sense, market has to drastically move above the total premium that you have paid. So that in that sense, that's a buy straddle. So if you're selling those premiums, then you are taking an unlimited risk that you believe that market will stay within the premium range that you have collected. That's why you are selling it, call and put option at the same time. So you are anticipating a non-directional movement when you are doing straddle or strangle. Strangle is basically you are executing the same strategy, the entering into the call and put at the same time, but OTM options, right? Most welcome, Chinmay. Can options be traded as intraday? Yes, of course you can do that. Definitely you can do that. There is no restriction. So time limit is definitely it's respect to you with respect to you and your view. So let's say you want to get in and get out in the options contract or futures contract in the day itself. There will be other people who are ready to get transferred or who want to transfer their contract to their them account. So their account. So you can transfer that contract at any given point of time. There is no restriction. That means you don't have to wait till the expiry. That is not the case, right? You can trade it in intraday as well. Yes, this live session will be available even after the end of the session, so don't worry. You can easily access this particular information even after this. You can repeat it, or if you also have any particular questions, make sure to ask them in the comments later on. So we will try to take a note of it and we'll try to answer that in the upcoming sessions, maybe in the form of masterclass or in the maybe in the form of videos. We'll try to do that. Most welcome, Rakun. Yeah, so there is a question from Shubham who is saying, sir, option buyers are those who buy call options and option sellers are those who buy put options. No. For individual options, for call and for put, there is a buyer and seller of the call option. There is a buyer and seller of the put option. Buyer of the call option anticipating or he think that market will move up, and seller of the call option will think that market will stay below that strike price. This is point number one. Point number two, put option, there is a separate buyer for put option, there is a separate seller for put option. Buyer of the put option think that market will move down or it will crash. At the similar time, seller of the put option will believe that market will stay above the strike price. So that's the difference. Karthik Raj, as a beginner, could you suggest which one would be less risky? Yes, in terms of the real statistics, I would say OTM option selling. So most of the people say it as a risky one, but if you calculatedly do it, there are ways to handle it calculated wise. Hedging options are there. If you are using those options, definitely option selling is less riskier in that particular case if you do it with a proper risk management and money management methods. Straddle, I already explained, Fizaz. You can watch this video later, you will get the answer. RHO means interest rates. So basically, any particular country has their own interest rates. So that interest rates will also be taken care in the calculation of the option price. But in the practical world, it may not be exactly the same that way the Greeks looks like. But the major things like price difference in the underlying asset and the volatility part and basically gamma parts, so those will definitely impact the options price. What is the minimum amount to invest in options? It depends on option buying and selling at the same time. So if you are an option buyer, the premium itself is the maximum amount you can pay. You don't have to pay any other amounts. Let's say Nifty 50, right? So Nifty 50, 100 rupees you are paying the premium, and presently the market lot size is 50. So 50 into 100, how much? So it is 5,000 rupees is what you pay to get into that particular contract as a buyer. Wherein if you are a seller, if you are an option seller, since you contain an unlimited risk, exchange asks you to put more. So let's say whatever the amount that you pay to get into the futures contract will be same for option selling as well. Whether it is call or put, doesn't matter. Can we buy options today and sell tomorrow? Yes, of course you can do that. Please don't ask the repeated questions. So I'll be taking the questions according to the session requirement and also the questions that will help others as well, right? How much minimum capital required to start trading in future and options? It depends on your expectation. Capital requirement is directly depends on your expected return if you want to speculate the market. So basically, let's say assume that your expectations are 50,000 a year and you want to do it with 50,000 capital. It's not like it is possible in some cases, but it is not the ideal way to look at it. So in that particular sense, have the realistic expectation and work on that. Maybe like minimum 3 to 5 lakh rupees will be more sufficient for executing call and put options as a seller or as a buyer, or even the futures contract. Any other questions? Okay, why we are not allowed to sell the put option? Why we are not allowed to sell the put option and call option on expiry day? No, I don't think so. That's not the case. I think call option and put option can be sold or can be written on expiry day as well. But what strike price matters the most? There is a limitation as per the exchange. So there is a limitation with which you have to do that. So available call and put option, definitely you can do that. How to read the chart for intraday? You can find more information about it in the Trading with Groww YouTube channel. Okay, so there is an wonderful question from Sam. So he's asking which chart to follow, option chart or underlying chart. So most of the cases, as I have seen, most of the people who trade in options refers to the underlying asset, because ultimately underlying asset will influence the price of the premium. So obviously they look for any chart pattern or any technical analysis, those they will look at it, the chart of underlying asset and also futures. So in some cases futures also. Mostly underlying asset will help you to understand the technical part of that particular underlying asset, and of course that will be reflected on the premium of the call and put option. I think I answered the question. Any other questions? Yeah, this is a wonderful question. This is a wonderful question from Saurabh, who is asking how to decide which strike option to buy in order to have maximum sorry, just a moment, maximum risk to reward ratio at the money. So basically at the money will have a chance of winning, higher chance of winning. And the second thing is that you are also premiums will be higher comparing to the OTMs, but you also have the higher possibility of market moving in your favor. If you also go right in the momentum, obviously you can make crazy risk to reward ratios when you are buying ATM or slight ITM comparing to the ATM. Like let's say 16,000 presently market is in, like 100 rupees below that call option. So 15,900 call option is the slight ITM of the same this thing. So when you are buyer, so I think that will give more reward comparing to the risk involved. Averaging is good or not in options? Okay, averaging is not good in anything. So basically averaging in the sense, see there it's a different strategy altogether. So let's say you are entering into some trade as a buyer or seller, doesn't matter, that is your initial thought process. So that means that's a different strategy altogether. And next time you are trying to average it, why? Because you are not ready to accept the loss in some sense, or you are not ready to, you are not comfortable with that trade. That is why you, our thought process is in being right. So being right is not the ideal way to look at the market. So basically you want to make money here in that perspective. So averaging out is not the ideal way. So in that sense you have to look the second entry as the separate strategy altogether. How to know movement of candles? Basically using the technical analysis. Stay tuned to Trading with Groww YouTube channel. For already we have uploaded many contents related to the trading related contents are there, technical analysis contents are there, and in the upcoming days definitely there are so many contents we are trying to upload there. Try to subscribe there and notification enabled, so we will try to upload the videos regarding that. Please say something for beginners. This is the beginning, Shivam. I think it's not Shivam. Siddharth, you can watch the video again because this will definitely help you to gain. I know these are the complex subject, which is again, you have to repeat the thing. So repetition is the mother of all learning. So you have to repeat the same video again. After this, it will be available for you to watch it in the offline. So you can watch this video later 2 or 3 times. You will have a complete idea of how these things works, right? This is a beginner content only. So whatever I have shared today with you is completely a beginner content. Most welcome, Sam. When will this video be available on YouTube? Just right after I complete the session, it will be available. How to understand candles by technical analysis. Most welcome, Tanmay. All right. So, well, I hope you like the entire session today. If you like the content, so kindly hit the like button. Also share this video with your friends so that they can also get the information about the beginner part of the fusion adoption. Well, so once again, thank you so much, guys, for your wonderful time. That on weekend. Definitely, that shows that you are keen and interested towards learning the subject. Keep learning and keep growing. We will be definitely coming up with a lot of interesting subjects in the coming days. If you don't want to miss those updates, kindly consider subscribing to the channel and also click on the bell icon to get the regular updates. And make sure to follow us in the Trading with Groww as well. So if you are interested towards trading, so trading related subjects will be available in that particular channel. So see you next time. Until then, take care. Bye bye. Jai Hind.